This week was one of those rare moments when politics, technology, and economics collided all at once. From Washington's most aggressive sanctions yet on Russian oil to Germany's unexpected rebound after months of stagnation and Meta's $27 billion move to reshape the future of artificial intelligence. Let's break down what happened this week and what it all means for investors, businesses, and the global economy. It started with a political earthquake. On October 22nd, the United States imposed sweeping sanctions on Rosneft and Lukoil, Russia's two largest oil companies, the first direct energy sanctions of Trump's second term. The message was clear: Washington's patience with Moscow has run out. Treasury Secretary Scott Bessent said these companies fund the Kremlin's war machine, freezing their US assets and banning all American transactions with them. Europe followed suit. The European Union's 19th sanctions package banned Russian LNG imports and targeted Moscow's so-called shadow fleet, those elusive tankers transporting oil under the radar. The UK had already moved a week earlier. Together, these steps mark the most coordinated Western pressure on Russian energy since 2022, and possibly the closest thing yet to Iran-level sanctions. Markets reacted instantly. Brent crude jumped nearly 5%, climbing above $66 per barrel, while WTI reached its highest level since July. Why? Because Russia isn't just another oil exporter. It's one of the biggest. And when refiners in China and India start cutting Russian imports to avoid US penalties, the global supply chain tightens fast. Energy stocks, on the other hand, love the chaos. The FTSE 100 hit a record high, lifted by nearly 3% gains in Shell and BP. But in Moscow, the MOEX and RTS indices dropped more than 3.5%, showing that these sanctions hit close to home. Meanwhile, the US bond market barely flinched. 10-year Treasury yields stayed steady, a sign that investors don't see runaway inflation just yet. But here's the twist: America's government shutdown delayed key inflation data. So for now, investors are flying blind. They see oil prices rising but have no official data to tell them how much is fueling inflation. In the short term, higher oil prices mean bigger profits for producers, obviously, but also rising costs for everyone else. Europe's manufacturing-heavy economies are particularly exposed, and US consumers could see higher fuel and transport costs heading into winter. If Brent crude holds above $70, central banks might need to delay rate cuts or risk reigniting inflation. Meanwhile, for investors, energy stocks suddenly look like a hedge again, while private credit returns shrink and bond markets grow more volatile. The sanctions, the data gap, and oil's rebound together have made this one of the most uncertain environments in recent memory. The real test now is enforcement. If the US extends sanctions to foreign banks or traders helping Russia sell oil, the impact could snowball fast. If not, it might fade, just like previous rounds. And globally, the market's dividing into two camps: Western-aligned economies tightening sanctions, and neutral countries like India and China quietly reshuffling their supply chains. The result? A more fragmented, less predictable energy world. While sanctions rattle the energy world, Europe got a rare piece of good news. Germany, long seen as the Eurozone's weak link, just posted its strongest private sector growth in over 2 years. The HCOB German Flash Composite PMI rose to 53.8, beating expectations and marking the fifth straight month of expansion. Services led the charge, rising to 54.5, while manufacturing finally began to stabilize at 49.6. Economists called it an unexpectedly good start to the final quarter. Still, there is a catch. Employment continues to fall, 17 straight months of job cuts. So while the services sector is recovering, factories are still struggling under high energy costs and weak exports. It's a fragile rebound, but a rebound nonetheless. And it's giving the European Central Bank a little more breathing room to keep rates steady. Now let's talk about Meta, the infamous company. And finally, from oil and economics to AI. Meta Platforms, the parent company of Facebook and Instagram and also WhatsApp, made headlines again this week. It announced 600 layoffs inside its superintelligence labs, the division leading AI research and infrastructure. But this isn't a retreat. it's a reset. Meta says it's restructuring to make its AI operations more flexible and efficient after its Llama 4 model underperformed against rivals like OpenAI and Google DeepMind. At the same time, the company secured a $27 billion financing deal with Blue Owl Capital, its largest ever, to fund new data centers for AI training. Essentially, Meta is outsourcing some of the cost and risk while keeping full control over the technology. For investors, this is a sign of maturity. Meta's shifting from rapid expansion to sustainable innovation, cutting costs, focusing on scale, and betting that leaner teams can deliver faster progress. It's part of a broader trend across big tech, AI consolidation. The wild spending phase is over. The efficiency era has begun. So, what can we take from this week? Geopolitics and energy are back at the center of the market story. Europe's rebound gives the global economy a small but meaningful boost. And big tech, once obsessed with expansion, is learning to grow smarter, not just bigger. In short, the world's financial pulse is changing. Volatility is returning. And whether you're trading oil, watching PMI data, or betting on AI, one thing is clear: stability is no longer the baseline. This is the new normal. Thank you so much for watching. Let's build the bridges and not burn them. Thank you and goodbye.